Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. You definitely want to be a member of the posse. And I do want to give a quick shout out to a past guest, Dave Greta, who just sent me a copy of his book, Night Trading. I do want to complain. It's 2022. Shouldn't you be able to read this? It's instead of being inversed, shouldn't you just be able to see night trading properly? So, with that quick short rant, I do want to welcome today's guest, Candace. You can find her on Twitter at Candace Mountain, and she also has a great YouTube channel as well. I'm going to throw it over to you to give yourself an introduction.
Thank you very much, Dave. Hi, everybody. My first time on Dave's channel. Me and Dave, we've run into each other a few times. We've been on different live streams and such together. So I was very excited when Dave reached out and said, hey, you want to come over? I was like, yeah, absolutely. So I run, my big thing is I have a YouTube channel. It's called Mountain Finance, where we talk pretty much everything. Well, everything stocks for the most part. I know you guys are a big fan of passive income. So is my community. I put up a lot of different lists of different stocks. I find different criteria. I bring them forth. Also some educational, informational type stuff. So there's a little bit of everything over there. And the best thing about the Canadian community anyways, I find that we're all pretty darn close knit. That's why Dave just has to say, hey, come on over. And I'm like, yeah, let's do it.
Yeah, awesome. Awesome. Thank you. So, obviously, you did mention Canadian. So, you are my third female guest, but you are my first female Canadian guest. So, that's awesome that you're here. And as you
Woohoo.
mentioned, we have bumped into each other on a few different live streams, whether it's on the High Rye channel in his community and Ken at the Freaking Oracle. And I don't think I've been on Tim and Nancy's channel, but I know I've definitely watched many of their live streams and have been in the comment section. So, and as you mentioned too, your community on your YouTube channel, the passive income, yeah, we love our dividends. And first, I probably should apologize because I haven't watched a lot of your videos or commented lately, and I know I used to do it quite a bit. I was watching and commenting on a lot of your videos, and
Oh, well,
as you
I
know
have to
from
leave now.
way back. Yeah, no, but as you know from way back when, even when you first started that channel, I was like, I love dividends, right? Like, I just love my dividends. I love seeing them roll in every month. And as you also know, I love REITs. So let's dive into REITs. What are your thoughts on REITs? What are some of your favorites? What are just I guess any thoughts on REITs? I know I love RioCan, so let's just
Yeah, no,
dive into REITs. Go for it.
absolutely. No, I'm a huge fan of REITs. I think that real estate is one of those things I've always want to get into, but I don't want to buy real estate. I don't want to go out and buy houses, and I don't want all of the pain of looking after it, going after people's rents, evicting people. Yeah, somebody else can do all of that. And the perfect solution for that, of course, is your REIT. So the real estate investment trust, I find them to be fantastic. One thing about them is they are geared 100% pretty much towards giving you dividends. So you usually get some higher yields with the REITs. And part of the reason they do that is because of taxes. They don't pay the taxes on that income, they give it to you. So, of course, those of you out there who love REITs, make sure you got it in a registered account so you're not paying any of that taxes, because it's 100% taxable. It's not sort of like 50% like a normal capital gain. So keep it in your registered accounts. Some of my favorite, RioCan, I think, is everybody's favorite. Everybody loves RioCan. I also love Granite Slate. Now, I find what Granite Slate does is they actually invest in a whole bunch of stores in the US. So they've got they've got a whole, like, I think all the Walmarts, for example, are part of them. And they're just very, very diverse. They have a half decent dividend. So I really, really love them. I'm also liking Northwest Health because they do a lot of the health REITs. And I think healthcare, especially with baby boomers getting up there, is going to be a huge sector. And so any REIT that's catering to the older sectors, to baby boomers, I think are going to do really well.
Yeah, definitely. So a couple of great points there with the one that you mentioned, giving you exposure to U.S. real estate as well, and that's great.
Mhm.
And I know a lot of my listeners, watchers have heard me say basically the exact same thing you just said of I love getting into REITs because it gives me the exposure to real estate without the hassle of being the landlord. I don't have to chase rent. I don't have to fix the toilet at 2 a.m. I don't have to do any of any then actually as you were talking, I was thinking about Northwest Healthcare as well. And I'm like, yeah, my favorite REITs and getting in let's dive a little bit into that. I guess thoughts on REITs like Extendicare and Chartwell. What and that's kind of going down that same path with
Mhm.
the baby boomers aging and needing healthcare. What are your thoughts on REITs like those ones
No,
and any others?
I would definitely say any REIT that is catering to health, sort of health or old age. I think those are going to be really good REITs to be involved in. I think that's going to give them a lot of stability. I know there's a lot of worry out there right now because of the situation with housing. There's a lot of people thinking, well, okay, if all of these mortgages are going to start going up because of rate hikes, is my REIT safe? That's why you want to make sure any REIT that you do have is diversified. Something like
Right.
RioCan, for example, they don't just have residential. They have a lot of businesses. They have a very good diversification. So if one group starts going bankrupt and starts, defaulting on mortgages, it's not going to pull that whole REIT down. And that's what you really want to look for in a REIT is the more diversification, the better, in my opinion.
For sure. Yeah, so actually the RioCan location that I'm most familiar with is actually the Kingston RioCan Center, which is like the size of 3 football fields and so many, retail stores and movie theaters, restaurants, Home Depot as its anchor location. So, even just within that one location is very diversified, right?
Yeah, no, absolutely. And I'm pretty sure I've been in the Rio Center in Kingston.
Yeah.
I lived in Kingston for about a year, so
I was born in Kingston and raised outside the city, but and I don't live there anymore, but I still go
mhm.
back quite often. So yeah,
Yeah. Now I'm
that's
not sure where in Kingston the Rio Center is. Something tells me it's not far from Princess Street, but I could be wrong.
it's on Gardner's Road between so Princess Street at the west end. So as you're going
Mhm.
out of the city toward say Napanee, and then on Gardner's Road, so south of Princess, which is at that point almost Highway 2 and almost south to Bath Road, but it's on Gardner's Road in Kingston.
Yeah.
Any sorry, geography lesson there.
Yeah, exactly. It's like, I'm trying to remember streets from years ago.
Yeah. Moving on, another sector I love talking about are the telecoms, and obviously, Bell, Telus, Rogers.
Mhm,
I recently had a guest who was really high on Quebecor in Quebec as well.
mhm.
What are your thoughts on the telecoms?
Well, I think the nice thing about the telecoms, I mean, when you look at the big three, so you're looking at TELUS, Bell, and of course Rogers, they've kind of got a monopoly on the Canadian market. That makes them very, very blue chip. Like you can't really default them. Now, I don't like Rogers, but that's more of a personal thing. I've always been more of a fan of TELUS and Bell. Um, Rogers, I think right now they've got a little bit of a shaky road ahead of them because the competition board is causing a little bit of a stir on that whole merger with Shaw. So that's going to be
Yeah,
interesting. I think no matter what happens in that, though, as I still think the freedom is going to go to Quebecor. So I think that's going to be a good thing for Quebecor. Give them a bit more exposure outside of Quebec because what we really need in Canada is we need another carrier coast to coast because that's the only way we're ever going to beat some of the cell phone bills. But as investors right now, I think they're very strong, all three of them. Uh, TELUS is one that I'm definitely kind of bullish on at the moment. They do have a lot of debt, and that is a bit of a concern, but they do have the money to service that debt. And I think they're going to get that under control because they are forecast to start making their earnings are supposed to increase. I don't know if it was like 10 to 15% a year. So that's going to be really significant. And I think as investors, I think you can't go wrong with either of the three, although I just don't like Rogers. But like I said, that's just I once worked for Rogers. So I just hold this bias against them.
yeah, no, and honestly, I've never really dealt with Rogers. I have had well, I'm currently with Bell, and I have been with TELUS in the past, and so, like, and I'm fine with both of those companies, and so as a consumer, I'm neither for nor against Rogers, and
Mhm,
as an investor, I'm not really looking at Rogers. I am looking well, I do have a small position in Bell, and I'm definitely looking at TELUS as well. So, and yeah, I agree that there's a couple great things, as investors, the fact that there's only the 3 of them, so more or less a monopoly.
mhm,
But as a consumer, you're like, "It would be great if Canada didn't have to pay the highest cell phone bills in the world," right?
mhm. That is true, and this is the way I look at it is the dividends I'm getting back from my telecom companies, I'm just looking at them as sort of like paying for my phone bill.
Yeah.
That was my goal with Bell. Own enough Bell so it pays for my phone bill.
And well, that's exactly what I'm doing right now is dollar cost averaging in to have enough shares to basically, yeah, if it offsets my phone bill, then that's what I'm trying to do. And I'm actually trying to I haven't started the same position with Hydro One, but I'm kind of thinking the same thing, buy enough shares of Hydro One
Mhm.
to do that and other companies. But since I brought up Hydro One, let's dive into the energy sector. And I want to ask you about Algonquin Power. What's going on there?
Algonquin Power, they've had a rough time. They've got a lot of
Yeah.
issues that are going on with their stock. One of the things that always worries me is that when the energy sector is booming and they're not, that's always a line for concern. Now, here's the interesting thing. Algonquin Power, a lot of their clients in the US, it's all fully regulated. Normally, regulation makes you a lot less volatile, but we've been sort of getting some situations where Algonquin has been getting in trouble. One of the things I think that's going to help them, and a lot of the trouble too, I think, is because they have a lot of people in the US, and that some of the issue and the recessionary pressures that have started in the US have hurt their bottom line, and that has hurt them pretty bad. Now, they have started to sell little pieces of their business to get into more regulatory customers within. Like I think there was a someplace in Kansas they were buying. Can't remember if it was called Kansas Utilities or something like that.
Kentucky
But
Power, was it not?
Kentucky, there we go. I knew it started with a
Kentucky Power.
K. So Kentucky Power, and that is going to give them more regulation, which should hopefully help them with that volatility. I do think that long term, I think long term Algonquin is fine,
Yeah.
but short term you're going to have some pain. And the dividend that they have now, I don't think they want to drop it, but they have to. They know they do. It's going to come down. So if you're looking at them as sort of a dividend payday, they're probably not the company to get into. But if you're looking at them as a long-term option, then yeah, absolutely, they're going to do fine.
Yeah, and I'm exactly looking at them both ways right now. I'm looking at my portfolio going, wow, I could really dollar cost average down on my position right now, but am I in for the hurt of a dividend cut?
Mm.
But is there that long term growth? And so, yeah, you're just weighing everything. With that said, I just wanted, I haven't seen recently, but I'm not sure if that deal with Kentucky Power has gone through or not. So there's, a little bit
I
of, for
I
those
think
of
it
you
was
watching, do
supposed
your
to
own
go.
due diligence and do your own research and find
Yeah,
out what's going
I
on
thought
there.
it was supposed to go through this month, but I haven't heard yet if it has or not. So but,
With
and I mean, the whole sector itself, I mean, the energy sector, everything from gas and oil had been absolutely exploding. There's a lot of companies, like you take PNE. So PNE, they actually had in 2021, they were a penny stock. They had a 400% growth spurt in 2021. And then about, I think it was a 62% growth spurt in 2022. And they actually have a half decent dividend. I believe it's around 8%. So there's been a lot of companies like that. Companies like Torlamine. Now they're a bigger blue chip oil company. They've been
yeah,
making so much money that they've had a special dividend that came out. And I love special dividends. It's like, oh, we're just going to give you some bonus money. Yay, I'll take it.
I like
Um,
bonus money.
Me too. I'm a fan. Like, if you ever want to give me free money, I will always take it. Always. I'll never turn
Yeah,
it down.
correct.
You know. Um, and of course, one of my favorite companies. Now, this is not technically an energy company, but Canoe EIT. is they have their fingers in energy, financials, as well as healthcare. So one of the things I love about Canoe is when oil is booming, Canoe does well. But when oil starts to falter a bit, Canoe sort of leans a little bit more on the financials and the healthcare. Now, if oil and financials is falling, then Canoe's going to come down a little bit. But they have a very steady, once again, it's a higher dividend, and they also have the potential for growth. So when you've got growth and dividends together, sign me up. I'm there.
Do you want to hear something really stupid I did in the last
Oh,
10
what'd
months?
you do?
Well, I had a relatively large position in Canoe. And for those of you watching or listening, it's ticker symbol EIT.UN or .TO on the TSX Toronto Stock Exchange. And I was up quite significantly and I sold the majority of my shares. And so I made like a nice, say, $1,000 profit. But I was also at the time, because it was a significant position, I was making like $100 in dividends. So now 10 months later, I'm thinking to myself, I would have made that same $1,000 and I'd still be making $100 a month in dividends. So I feel
Mhm.
like I did something dumb.
Yeah. Well, it depends on what you put that money into, right?
Right.
So if you put it into another stock that has done well, then maybe it's not as dumb. You know, because I always look at it this way. I have a policy. It never hurts to take profits.
Yeah.
You know, it has to be do what you do. And it's funny. Sometimes like I will sell things in the reds. A lot of people won't. But I like to do sideways investing.
Hmm.
So if I have a stock that's doing horrible and I don't see a lot of potential and the fundamentals don't look good, I will sell and I'll buy another stock that's in a similar situation but with better fundamentals because I'm going to get my money back faster.
Right.
So I don't mind doing that. I know that sometimes I've seen some investors, I've even had a few people in the community who are like, "Oh my god, why did you sell that in the red?" It's
Yeah.
like, you got to use the math. I
Right.
always
Yeah.
like the math. If I can make more money on another one, then yeah, I'm going to move it over. No doubts about it.
Yeah. Great point. Great point. And yeah, so honestly, it wasn't really a question, but to let you know, I I should have just left it where it was.
Okay.
Oh
Yeah.
yeah,
It is
wow.
one of those things. Like I'm a little over like I've got about I think I have 500 shares of Canoe. So I'm a little bit over diversified in them, but I'm not going to sell them. I'm just going to not buy any more Canoe
Yeah.
as I build up the diversification of other stocks around them. Because I'm sort of in that situation where my TFSA is maxed, so I can't throw new money into it. The only money I really have to work with is if I do any kind of selling and rebuying, or of course, all of the dividends coming in, and then I just
Yeah.
move them around to sort of, help with diversification or move into other positions. And
Yeah, so even with that 500 shares of EIT, you're not going to turn down that monthly dividend that they're sending you every single month, right? So
no, of course not.
and like I said, I was up to $100 a month in that same dividend and actually over 100, and I'm like I still have a bit, but it's down to like I think 10 or $12 a month, and it's like I
Yeah.
really wish I had just held on to that $100 a month because that's a nice paying dividend, right? But
Well,
hey, live and
exactly.
learn, live and learn.
Exactly. No, you can't go wrong with Canoe. And it's funny, Canoe was the first breakout video I had on my channel.
Oh,
'Cause
nice.
it was
I'm
like
sure
last
I'm sure
year. Well, last year I
I'm
did
sure
a
I watched
live
that one.
stream. Yeah, I did this live stream on Canoe. It was a Christmas live stream. And so I brought up Canoe because they had a special dividend, and I was just, talking about it on that live stream. And the odd thing is, after Christmas and it moving towards the spring, I noticed that people kept watching that live stream, even though it was a Christmas live stream. I'm like, what's going on? It's got to be Canoe. So I made a
Yeah.
Canoe video, and it's still to date, it's the most viewed video on my channel. So it's just like now I'm at
Nice.
that point that if I don't do a Canoe every quarter, I get people saying, "Hey, can you do a Canoe video?" So that's
And
kind of
there
good.
is your YouTube channel right there for those
At first, I
watching on
thought that we
YouTube.
crashed because I was like, "Wait a minute, where'd we go?"
No, I'm sorry. I was just bringing up the other screen to show off your
Oh yeah.
beautiful YouTube channel. So many great videos. Like I said, I've watched a lot of them. I haven't watched as many recently, and I do apologize for that. I do have to get back to watching more videos, but I also have been interviewing nearly 30 guests in the last 2 months, so my
Exactly.
time
And
has
as you
been a
can
little
see,
bit.
the last video on my channel, 7 safe high div stocks. It's perfect for your audience.
Yes, you're 100% correct, so I definitely will link your channel in the description, and people that wanna check that out can easily find your channel.
Well, absolutely. And of course, I'm going to throw a link on my channel over here once you've got this up.
Yeah, that's would be very appreciated, obviously.
Yeah, absolutely.
So, what we haven't talked about yet is they're so great. You love them. Everybody loves them. Let's talk about, well, you love them as an investor. You might not love them as a consumer, but you love them as an investor. Let's talk about Canadian banks. I think you did mention National there earlier, but let's dive into the Canadian banks.
Oh, yes. Right now, as an investor, this is an opportunity, our banks right now, because they are on a nice deep discount. So there's no worry. They're all blue chip. All of the six, whichever one you like, is going to be fine. But I want
Yeah,
to use one as an example. I'll use the Bank of Nova Scotia. So Scotiabank, normally their dividend yield is about 4 to 4.5%. Right now, because of this financial situation that the banks are in, you're getting that yield at about a 6%. And that's amazing for
yeah,
this bank. And it's also a bank. And here's the beautiful thing. If you buy the Bank of Nova Scotia right now, not financial advice, but just saying, if you did buy it right now at that 6%, you're also going to get all that growth back. Because
yeah,
when we get on the other side of this bear market, and keep in mind, we do have a recession coming more than likely. But the beautiful thing about a recession is about halfway in the middle of the recession, that's usually when the bull market starts.
right.
And that powers us out of that recession. So you're going to be looking at some really great growth on the banks. In addition to, you're getting bigger yields than you normally should be getting on these really, really insanely blue chip stocks. So I'm totally bullish on all of the banks. I also like even the smaller banks. I'm kind of liking. Like I do like Canadian Western,
Yep.
and I'm also EQ Bank has been doing some pretty good things stock wise as well. Just to throw that out there.
Wow. So you're going beyond the big six, and you're going, let's dive even deeper into the banking system in Canada.
Yeah, why not?
Right.
I mean, it is a good system. I don't foresee anybody losing money on banks.
Yeah, I would agree. And again, I agree with what you said. Not financial advice, but yeah, if you're looking at banks and you're looking at the Canadian banks, it's tough to go wrong with any of them. Whether it's the Bank of Nova Scotia owns half of the set, I own the other half, and um, but yeah, you're right. Like whether it's Royal Bank, Toronto Dominion, Bank of Montreal, CIBC.
Mhm.
Um, I
Oh
missed
yeah.
one. Which one did I miss?
Um, did you get? No, you got Bank of
I
Montreal,
got Yeah, I got Bank of Montreal, TD, CIBC,
National.
Bank of Nova Scotia, Royal Bank, National. I did name all 6. Okay,
Okay,
sorry.
there we go.
Oh, another one that's near and dear to my heart is the consumer staples sector. And I know we don't really have the same as in the US where, you have your Walmarts, your Costco's, your Coca-Cola, your PepsiCo,
Mhm.
and kind of the list goes on, General Mills, and the list keeps going on. So, what do you see in Canada that is in sort of that consumer staples category? And once you, I guess, respond to that, I'll sort of let you know what I'm into and what I consider sort of consumer staples within the Canadian sector.
Here's the funny thing. When it comes to consumer staples, most of my investing dollar in that sector is in the US.
Right.
So I do have McDonald's. I do have Coca-Cola. Um, so that's all fine. But I do have Loblaws
Yep.
in Canada side. So I also have a little bit of Alimentation Couche-Tard. So I have a little bit of them because they're really good.
Yep.
And I also have Dollarama. So I do have some Canadian now that I think about it.
Nice.
Um, see, Dollarama, for example, I'll use them as an example. They're definitely a great investment because as we move towards a recession, as people are more and more not wanting to spend a lot of money on stuff, going to the dollar store is pretty much a nice, easy way to save some money, and pick up some of those things that you want, or things that you need, or things that will do until the economy's better. So they're doing really, really well. ATD, so Alimentation Couche-Tard, they're massive. They have corner stores everywhere. They've got them in the U.S., Canada. They've got them in Europe and China. A lot of them are different names. Like in the U.S., they have a chain called Bigfoot, which I think sounds really cool. But they're massive. They're everywhere. People will always use corner stores. They're just so convenient. That's why they call them convenience stores. So that's another company I think that I wouldn't underestimate. So I think there's definitely a lot out there. Anytime you're looking at least as long as it's a big chain and you can see a reason for the chain, like something like, for example, Staples. Staples is probably never going to go under.
Right. So I should just mention that just in the last 3 or 4 episodes, you're the 3rd or 4th person to bring up Couche-Tard, because I guess I just need to look into it more, because everyone is 100% correct. Convenience stores, corner stores, they're not going away. They're convenient. Everybody uses them. You just go and grab your bag of your Fritos, your Doritos, and your Pepsi, and so you're getting 2 stocks with one at the corner
Right.
store,
But
basically,
what
right?
also do corner stores have? Gas.
Gas.
So, you're making money off of that too.
Yeah.
So yeah, no, the funny thing about Alimentation Couche-Tard is that I was hesitant to do a deep dive on them because I was afraid I wasn't going to pronounce it right. But eventually I was
I
like,
think
all
you're doing
right.
great. I think
Well,
you're
I
doing
watched
great.
different people pronounce it over and over again. I'm like, okay, I'm going to get this right.
Nice.
And then I watched somebody from Quebec say it, and I'm like, yeah, no, I'm saying the English version of it, but I'm okay on that.
Yeah, so like I said, I what I have in Canada is I have Pizza. I'm sure you're well aware of that stock.
I
It's one
do
of the
have
bigger ones in my
pizza as
portfolio.
well.
Yeah, so I think it's a great one. Simply, people are gonna eat pizza no matter what.
Mhm.
They might pick Domino's or Pizza Hut, but they're also gonna pick Pizza because it's a big chain in Canada. So, and I love that monthly dividend. It's a pretty decent yield. I'm not exactly sure what the actual percentage is right now, but I know it's a very decent monthly dividend, and I'm very happy with the amount of money they give me each month to not work for them. Right?
Well, yeah, exactly. Well, the thing about that pizza stock too is it's not technically the store; it's a royalty. So it's
Okay.
basically they're making a small bit of profit off of all of the franchises who are
Right.
using Pizza's name. So they're just a nice royalty. That's what I love about royalty is that the royalty stocks tend to have insanely next to zero debt most of the time.
Yeah.
And the money just keeps coming in free. And all they're doing most cases is they're just paying their overhead and then sending it out in dividends. So that's why you tend to get some good dividends on some of the royalty stocks out there.
Yeah. I love. And so SRV, which is Sir Royalty, is another one that
Mhm.
I have, and they have like the Jack Astor's chain around Toronto. I'm not sure where else Jack Astor's is, and I'm not even sure what other chain restaurants they have, whether they have Kelsey's and Montana's. I have no idea which
They may
chains
have
they have.
Kelsey's, but here's one of the things about Sir Royalty is that if you look at them, not only do they have a great dividend, they've actually been growing really well.
Yeah.
So when you look at a total return on Sir Royalty, it dwarfs a lot of the bigger dividend stocks. You're just like, wow. Because I think their dividend's only like 7 or 8% in that area, but with
Only.
that growth, add that in, and you're making bank with that one.
Yeah. So that's another one that I have. And again, it all depends on perspective, what you think a large position is, right? Some people think that 100 shares is a lot. Some people think that 10,000 shares is an average amount, right? So, in my opinion, I have a relatively large position in Sir Royalty, and honestly, I would like to buy more, but I keep looking at everything else, and I'm like, well, I can dollar cost average down on everything else, and right now I'm up kind of big time on, not big time, but big enough that I'm like, okay, I guess I'll just let it ride for now and keep letting that monthly dividend roll in. So I'm happy with
Yeah.
it.
The way I look at a large position is I just go by percentage. I like to try to minimize my percentage of 5% of my portfolio into any one stock.
Right.
So if my position is, if I have more than 5%, I've got a large position. That's how it works out. So it doesn't really matter what the money is. Just play it by the percentages.
Yeah, that's a good way to look at it. I guess I'd never really thought of it that way before. That's a really
Oh
good way
yeah,
to
like
look
if
at it.
you've got 50% of your portfolio in one stock, you've got a very large position in that stock.
Yeah, right. Yeah, and you know what? If you're just starting out, maybe you do. Maybe you've like went all in on one company, and but
Yeah.
over time you're going to probably find some other
Well, one
companies, and that's going to even itself out.
one of the things I'll tell people is that if you're just starting out, look at some good ETFs to give you that diversity, whether
Yeah.
you want to look at a Vanguard or whether you want to look at an all equity, because then you're going to at least get that before you start going into individual stocks, build up in some ETFs. And then once you've got that capital and you're ready to start going into others, then start bringing the other stocks in. And maybe you can even scale back on the ETFs once, depending. Some people don't want to really do any work. And if you want a full on hands off approach, then ETFs is your way to go.
Yeah, exactly. That's great, not financial advice.
Well, it's common sense.
Yeah.
Now, my
One last
first,
one in my portfolio, I think I'd have to look at it, but just back to that consumer staples and the food industry is Rogers Sugar. What any thoughts on Rogers Sugar?
RSI.
Correct.
I mean, I do like them. I don't hold them. I did hold them, I think, briefly, and then they went up really high, and I sold them because I wanted to diversify into something else at that time. But I think right now anything that's in food, so whether even Roger Sugar, or if you want to go even bigger into something like Nutrien, I think those are going to do well over the next, especially as long as this war is going on with Ukraine. There's going to be a high need for different different food products. So,
But sugar goes into all of it anyway, so
well, it kind of does nowadays.
yeah.
So, but no, I think it's a solid bet, and it's also pretty inexpensive. So,
Yeah.
it's a good little stock to get into.
Yeah, that's one of the reasons I like it. It's, it doesn't cost a lot, has a nice yield. Again, it
Yeah,
pays a
we see my
quarterly
little,
dividend.
I guess my little guilty pleasure stock is Diversity Royalty, which is DIV.
Okay.
It's about $3 a share, and it's got, I think, a 7%, I think 7 or 8% royalty dividend. So it's just whenever I get like a little bit left over, I just throw it in to
Yeah,
div, and I think I have I think I got like 1,100 shares of them right now, but
nice. I do the
they
same
always
thing.
pay.
I do
And
the
they have
exact same thing
they
with
hold the royalties to Mr. Lube and Air
oh, wow.
Miles.
So,
So
yeah, I do the same thing with, BTB and PLZ,
mhm.
which it's like, okay, I've got $5 left in my brokerage account instead of just leaving in my Wealthsimple account, instead of just leaving that $5 sitting there as cash, well, I can buy BTB and get another 2 cents or 4 cents or 3 cents a month in a dividend, and I'm okay with spending that $5 to or $4, whatever they're at, right, to get another 2 or 3 cents added to my monthly dividends. So,
Well,
but
yeah,
yeah, same
exactly.
kind of same strategy as you. Just toss that last $5 into something that's going to give you another little bit of income, right? Why not?
Well, yeah, I mean, otherwise it's just sitting there and it's not gonna make you anything,
Right, right.
so I'll
And
do
yeah,
it.
that's exactly the way I think about it. That's exactly the way I think about it. Um, Healthcare is also on my list of sectors, and I know we touched on Northwest Healthcare and Chartwell and I think Extendicare when we were talking about REITs, but and again, I guess healthcare you kind of get into some of the U.S.
Mhm,
stocks, Johnson and Johnson and Pfizer and whatnot. But
mhm.
anything in
Well,
the healthcare sector that
one of my
excites
favorite
you?
healthcare stocks is, well, it's insurance actually, but I mean, it's still connected to healthcare, Manulife Financial.
Okay,
So they're undervalued for one, and they've just been doing really great recently. I just love that stock because it's reliably stays in this nice little zone. I also day trade them, so but that's another story.
yeah,
So they're one of my favorites when it comes to healthcare for sure. I mean, I think the whole healthcare sector, as I sort of mentioned, with the baby boomers getting older, there's going to be more needs. Now, here's this thing: when you're looking for things to, perhaps do your due diligence on, when you think about the fact that baby boomers are getting older, there's going to be a lot more needs for everything from old age homes to just anything medical. Also, things like, well, on the darker side, there's going to be people who make caskets are probably going to be doing very well as the baby boomers start passing along.
Right.
So these are always investment opportunities when you get in there and you take a look at some of this. Now, some of the old age homes, like let's take Sienna, for example, they are not doing the greatest right now, but a lot of that is because with Sienna, for example, Sienna Senior Care, they had a situation during the pandemic where they had 4 people in a room, and all of a sudden they were told, no, you can only have 2 people in these rooms because of the transmissibility of the virus. So they kind of lost half their revenue, which is why they're kind of in rough shape right
Right.
now. But keep in mind, they're also getting funded by the government at the same time, so there's no danger of them ever going out. And I was talking to somebody who works there, and they're building a whole bunch of new facilities, and they're on the verge, probably within a year, of making a complete comeback. And that's going to be a market that's going to be very profitable in the future. So it's one to maybe not invest in right now, but throw them on your watch list. Watch them.
For
And when
sure.
they do start to look like they're starting to get profitable, then it might be time to do some more due diligence, look at those fundamentals, and they might just be perfect for your portfolio.
Yeah, awesome. Awesome. Yeah. I keep joking with a coworker. Her and I talk about dividends all the time as well, and I keep joking with her that I need to buy Chartwell before I have to move in there.
There you go. That way there, you can go in and you can tell the nurses that you own them.
That's right. I own this place. I
I
only
own
bought
this
one share,
place.
but I own this place.
Yeah, no, exactly. Why not? It's,
Oh,
I
wow.
I'm sure you
This
wouldn't be the first investor to do something like that.
Yeah, I'm 100% sure, right? There's probably a whole bunch of old guys and, well, men and women in the Chartwell homes that are saying the exact same thing because they have 1 or 10 shares or something, right?
Oh yeah, go into McDonald's and just say, "Hey, I own some shares in this company. Does that give me a discount?" So you
Yeah,
never
maybe I should
know.
try that at Pizza, right?
Well, exactly. Other than the fact that those would be, of course, franchises compared to the
Oh,
royalty, so they
right,
wouldn't
right,
care in that case.
right.
But
Yeah, yeah.
but
Another sector on my list is technology.
um,
Tesla, Apple, Microsoft, BlackBerry. We're on Canadian stocks. Let's
yeah. Well, no, Canada has. Well, we got 2 big tech companies. You got Shopify, who
Yep.
of course has been decimated. With it's just not surprising that they were decimated. Once everything started kind of crashing and people are no longer doing as much online, they were destined to fall. Now they
Yeah.
haven't. Here's the funny thing: if you think about how far they've fallen, it looks bad. But you also have to realize that they were artificially pumped by the fact that everybody was in a lockdown at home buying stuff online.
Right.
So that extra bump, they fell that too, but that was just normal. That was an extra bump that wasn't supposed to be there technically. So they're not as bad off as people think they are. Now, so we also have another option. Constellation is the name of the company. Um, and they make a software, and I can't remember exactly what it does, but they're a really expensive stock. Now you'd have to pretty much most people starting out would probably have to go fractionally on them because I think their share is like somewhere's up around $2,000-3,000 a share. Like they're
Oof,
really expensive,
oof.
but they've been
Yeah.
doing really well on the Canadian side. Now, of course, on the American side, we've got so much problems. Like some of the companies like Microsoft, Apple, Google, um,
Amazon,
maybe
Facebook,
even
Twitter.
Meta, but Meta, if any of the big ones is going to fall, it might be Meta, but um, I still think they're going to recover. But I would say if the percentage wise, if I had to pick one to fall, it would be Meta. But I think Apple, Microsoft is doing really well. Apple, I think, is going to do fine. Um, Google will also do fine. So we have a lot of good tech options in the United States. Now, interestingly enough, Purpose has come out with a whole bunch. They released a whole bunch of new ETFs today. So you know how they like to do their high yield, like they've got the BTCY one? They're now doing those with American tech companies.
Oh,
So
wow.
you can now get a high yield Apple, you can get a high yield Microsoft, high yield Google. And they're just doing the same thing using covered calls to enhance the return on
Yeah.
those. Now, here's the beautiful thing. Those you can only keep the technology sector down for so long in the US. Knowing which ones are going to survive. So knowing like Apple, Microsoft, Google, well, they're at a huge discount. So you got a couple of different options. As a Canadian, I just like to buy the actual American stock because I have Wealth Simple Plus, so I just put it in my US account.
Okay.
But you can also do it through CDRs up here in Canada. So those are certificates of depository. So receipts of depository. So CDRs. You can do it through a CDR, or now you've got these purpose ones. So you can get these ETFs and you'll actually start making some extra dividends on the side. And the beautiful things with these is these ETFs will probably explode in price when all of these tech things go back up.
Right.
And that's going to happen. You're probably looking at what I would almost do, what I would almost recommend is anybody interested in doing tech in the US right now, now's the perfect time to just DCA, DCA
Yeah.
all your way up to the bull market and then start counting your money after that.
Dollar cost average is one of your best friends when it comes to
Oh, yeah,
investing.
absolutely.
So I do have some homework for you, and luckily
Oh,
he went back and in the comments timestamped the entire video. So one of my past recent guests on the Passive Income Podcast, his name on Twitter is at Newcomer Investor, and that's the title of the video with at Newcomer Investor. And he was actually rather bullish on Meta. So you're gonna have to
mhm.
go back and, like I said, in the comments, he timestamped it all, so you can find where the Meta segment is. But he was actually quite bullish on Meta. So you have differing opinions, which is
Yeah.
great. That's
Well, just to be clear, I'm not saying that Meta's going to falter. A lot of people use Facebook and that's not going to change. But if I had to pick one,
it wouldn't be Meta.
it would if I had to pick one to fall, that would be the one I pick. But
Oh, yeah.
I still don't think they're going to. I want to just be clear on that.
Okay.
Um, I think they've got a rough road ahead of them. I think it's going to take them a little bit longer to recover than, say, Google, for example. But keep
Yeah.
in mind, Meta also owns Instagram, and Instagram is doing okay.
Instagram's doing very well, it seems.
Yeah, exactly.
And Google also owns YouTube. So,
Exactly. So we have to be pro because this is on YouTube. So
yeah, definitely, right? Yeah.
there are overlords. It's like pray to Google, and then maybe they'll give you some more AdSense. I don't know.
Oh, wow. That's awesome. This has been an incredible conversation. We've kind of plowed through a lot of the sectors that I like to talk about. There hasn't been a train go by yet, so we haven't talked about CN and CP.
Oh,
That's another part of that
I,
actually
I'm
same
I
podcast.
love I love both CN and CNR.
Yeah,
And I will tell you right now, you can't get more recession proof than stocks that are in supply chain entities like railroads, at least in Canada. In the US, it's a different story. But that's because they have a lot of issues with, mostly labor issues. So up here in Canada, we did have potential labor issues on both CN and CP, but they
yeah,
got quashed very fast. They never let it happen. Now, both have benefits. So CNR right now, I think short term wise is going to be your most profitable, but I think long term wise, CP might give them a big run for their money. So here's what I like about CNR. CNR is pretty much our only railroad that has a lot of access to the Canadian North, where our critical minerals are. And with the government putting a whole bunch of money into critical minerals, that makes CNR very essential. And I
yes,
think you're going to see a lot of growth in CNR. Now, they don't have a big dividend, but they have a lot of growth. If you look at CNR as a total growth perspective, um, it's like they have a big dividend, a very big dividend. I've seen some years where their growth has been like about 20% total growth between the dividend and what they've actually grown. So I think that's really, really big. Now, CP, jumping over to Canadian Pacific, they have just bought Kansas City Southern. Now, there is one regulatory board hurdle that they still have to get past. It's the last one, so we should hear in the new year if this is official. But if this is official, they're the only railroad in North America that will have access to Canada, the US, and Mexico. Because like CN has access to the Gulf, but they don't have access to Mexico. That's why CN wanted Southern Kansas
Well,
City
that's why they
Southern
both wanted them,
big
right?
time.
So they'd have tracks in all three, three
Exactly.
countries.
And here's another interesting thing. I don't know if people know this, but CNR is the second biggest railroad in the world.
I
Most people
didn't know
don't know
that, but
but
it's
they
very
are.
believable.
So they're huge. The biggest railroad is actually, who is it? I think it's Union Pacific in the US. They're another massive one, but they're also having issues with labor. Now, I'm invested in them. I can wait out the issues that they're having because they're not going anywhere. But that's been the big thing in the US is with their supply chain and letting some of the strikes go on or come close to going on, and some of the disruption, and also worker shortages. That has been a big issue in the US where they've got all of this supply that they need to transport, but they just don't have enough people that they can't utilize their trains as effectively as they should be able to. And that's what's caused a lot of issues down there. But once that all gets fixed, I think you're going to see some big growth in that sector as well. So I love railroads, but that might be because I used to love winning Monopoly when I was a kid.
And now you're winning Monopoly as an adult.
Railroads.
Yeah, and so Union Pacific and CNR, I don't know this for fact, but I know this just from visually seeing it outside my window every day, and when I'm driving to work, parallel to the train tracks, is that Union Pacific railway cars are on those CN tracks all the time. Every day I see a Union Pacific rail car attached to a CN, a Canadian National, the engine of the train. And every day Union Pacific is right there with all the CN rail cars as well. So, I guess I'm sure they must be working together in some capacity. So there's that as well. There's, just the working out. There is a train. Oh, that might have been a Via Rail train, actually. So there's another one. Via Rail trains going on the CN tracks, right? So they're making money, basically renting out their tracks to Via Rail.
Oh yeah, no, absolutely. But yeah, definitely a sector I love. Always will love my railroads.
Nice. I do pretty much know I can always do a railway segment, and eventually a train will pass by the window.
Well, exactly. Now, of course, if it were summer and light and we could actually see the train go by, that would be like perfect.
Yeah, well, actually, when I've recorded on the weekends, it's been too bright. So I guess I just have to find the right time of day for the lighting as well. Yeah. So
Or wait till Beetlejuice goes supernova and that'll add a bit more light.
awesome. So wow, yeah, well, we've covered all sorts of sectors already, and I don't know anything else you'd like to talk about. Just throw it open.
Well, no, I think we covered all the sectors. Unless you got burning questions, I've always got burning answers. So.
Oh no, I think we've done great. Like I said, definitely want people to go and check out your YouTube channel. You have so many great videos over there, and you can easily find that. Like I said, I'll put the link in the description. And yeah, basically, closing thoughts or anything you'd like to say.
No, I think I'm good. I think I'm pretty good. I think just in closing, this is an exciting time to be an investor. One of the things that people need to realize is that in recessions, in bear markets, that's when the real money is made. So you want to get in there, you want to DCA, you want to hold on to things. And when you get to the bull market, you'll be so glad that you did. There's so many people that kind of give into the psychological pressures. So FUD and FOMO. There's so many people that when their stocks kick lower and lower, and they're like, oh my God, I'm losing so much money. I just got to sell. I got to stop the bleeding.
Yeah.
Well, the second you sold, you have just cemented a loss. And the funny thing is, that same person who just sold when it's low, when it turns around and starts going back up, they're like, oh no, what have I done? I got to buy, I got to get back in. And they're buying up at the top. And then if it goes back down again, they're selling. So many people are doing the exact opposite of what you need to do to be successful when it comes to investing. So this is a wonderful time to be DCAing, building up your portfolio, getting ready for the bull market, and you'll be happy that you had, especially if you're chasing the dividends. You're going to get better yields now than you will get. And here's that thing. Keep in mind, if you have something right now like Scotiabank, which has a 6% yield, well, when we go back into the bear market and the yield's back at 4.5% or whatever it is, you still got your 6% yield on those stocks you bought. Any new ones you buy will have a 4.5, but the group that you bought, you're still getting 6% off of that whole group. So you don't lose your yields as they go up and down. It's when you bought it. So always keep that in mind. Enjoy this time investing. Make some money, folks. Let's all make money together.
Yeah. With that said, let's all look forward to a very happy and prosperous 2023. Let's put some dollar signs into our accounts. A whole bunch of dollars
Absolutely.
into our accounts. Yeah. And that was, again, great, not financial advice. But yeah, you're getting that 6.5, 7% yield now. It might be 4% down the road. And I guess one final question: would you kind of average that out, then say, okay, well, over my average then is say 5% or 5.5%, or would you just think 6% here, 4% over here?
I don't really track it, to be honest.
Okay. You're
It's
just
just one
show
of
me the
those
money.
things.
Just keep the dividends coming in. And don't worry about it.
Exactly. It's like you got the 6% when you bought it. When it's more expensive, you have that many more shares, so it kind of works its way out anyway.
Right.
Because look at it this way: when it's more expensive, you'd have to buy a lot more shares to equal what you're getting already in dividends,
Yeah.
more than you paid, and that'll come through when you look at the average cost on the shares. So your ACW stats. So it's all there. You just have to look at it,
Okay.
and every time you get that little notification in the morning that you got dividends, you can be a little bit happier that you got a better yield than people starting to buy today.
That's my favorite dopamine hit of all time, when that Wealth Simple goes off in the morning and says, "RioCan paid you to not work for them. Pizza
hmm
Pizza paid you to not work for them." You're right. Like,
Yeah, I mean, even today, I think Manulife Financial was the dividend that came in today.
paid you to not work for them. Right.
Exactly.
Oh, wow. So this is, I see we're already well over 50 minutes. This has been another great conversation on the Passive Income Podcast. I thank you so much, Candace, for spending some
Oh,
time with
no
me.
problem.
This has been a great conversation. You are so knowledgeable, and I really appreciate that. You're just, a fountain of knowledge, it seems, and it's, very appreciated to get to talk to you and for you to come on the Passive Income Podcast and spend some time with me.
Absolutely. Always happy to help out the community.
Awesome. Thank you very much. And if you're still watching this late in the program, you definitely have to click that subscribe button below. Those are the rules. I don't make the rules, but you're still here. You're still watching. Subscribe.